Hello everyone and welcome to my channel. Today we are going to be discussing Switzerland and how you can invest in these beautiful countries through ETFs. First, you need to ask yourself, why would you want to invest in Switzerland? We all know one of the best markets to invest in is the US. But if you're looking to invest in Switzerland, there are a few similarities. So I will give you a few examples of those. So the first one, you have political stability. So everyone investing in a country, make sure that the country is politically stable. That's gonna save you a lot of money. Like for example, you're investing in some countries in Africa such as Congo or other such countries. I can guarantee that it's very difficult to make money in such countries because it's gonna change, or the day after today you can have the government coming and seizing your assets for nothing, so you're not ready for that and you're losing everything. Another reason is that in Switzerland you have a strong access to financial markets, which means if you're a company, you're looking to get some new capital or you're looking for debt, it's going to be easier for you to look for those funds. So you're going to have a good access to those funds, and then you can reinvest this money into your investments or whatever you're looking to invest in. So the third one I would say is in Switzerland, of course, you have low taxes. So whenever you're talking about low taxes, it means it's going to attract big companies that are just looking to come here in order to decrease their tax liabilities. Another factor is that you have qualified workforce, which is very important. If you're coming here, you need some people who are skilled, qualified, professional, have a good, strong sense of ethics. So you're gonna be able to find that in Switzerland. And the last factor is that you have strong entrepreneurial mindset. You have some huge university in Switzerland, just in Lausanne. You have the EPFL, you have the EPFZ in Zurich, and they're producing extremely talented people. Well, so now we know we can find there are a lot of similarities between Switzerland and the US. So we can see that Switzerland is definitely a country which is following the rule of capitalism. So every country which is following those rules with low regulations, for-profit organization trying to maximize profit for shareholders. So most of the time you have companies who are growing really big and making a lot of profits. So that's the best country to invest in. Well, so now we know we can find there are a lot of similarities between Switzerland and the US. So we can see that Switzerland is definitely a country which is following the rule of capitalism. So every country which is following those rules with low regulations, for-profit organization trying to maximize profit for shareholders. So most of the time you have companies who are growing really big and making a lot of profits. So that's the best country to invest in. And I will present you now how you can invest in Swiss companies. So I will say there are many different ways. So the first one will be, I will give you 3 examples. So the first one will be you can invest directly in stocks, which is it's taking a lot of time because you need to analyze like hundreds of companies before you make any single investments, and you may be investing like you can be working on that full time. It's taking so much time to analyze just one stock. So analyzing 100 stocks, you're gonna lose your time. Unless you have a lot of capital and you're passionate about that, otherwise it's a waste of time. The second way you can invest in Swiss stock would be through a fund manager that you will trust, and that will try to deliver big return over the market returns. But it's very difficult to find any good managers. And as we've seen, there are a few charts that mention that like 97% of fund managers, they cannot overbeat the market. So that's why I will lead you to the third option, which is investing through ETF, which is passive investments. And those passive investments, like 90% of the time, 97% of the time, they are doing a better return than active managers. So those passive investments, they have a few rules that have been enabled since the beginning, and they will follow those rules in order to invest. And the way the investing is very simple. Most of them, the rule is to invest in the best companies, and they will sell the company that are going down. So you can see it as, I will give you an example. So just like soccer, if you look in soccer division, you have the first division, the second division. So the first division you may have 10 teams, the second division you may also have 10 teams. So whenever in the first division the largest team, the 10th one is not performing well, then it will be downgraded and go to the second division. But the best team of the second division will be upgraded and go to the first division. So ETF are the same. They will just get the first 10 or the first 20th biggest companies, and every time the ladders of the ladder get back return, they will be downgraded, removed from the index, and you will get a new one coming in to replace it. I'm going to show you some different ETF that you can invest in, so you get direct exposition to the Swiss market. So bear in mind, so every time you're investing in the funds, ETF, they're gonna replicate a benchmark, an index, which have rules. So now we're gonna start to understand what index exists in Switzerland. So there are some index that have been created by the SIX group, and the most popular one, there are 3 of them. The one I will show you, the SPI, I'm gonna show you the SMI, and I'm gonna show you the SMIM. So the first one, the SPI, you can definitely say that's the Swiss index. It's covering most of the stocks in Switzerland. Here they're mentioning it covers roughly 99% of the free float market capitalization of the entire Swiss market. So at the moment you have 220 stocks that are included in this index. Second one is the SMI. So this one, I would say that's the most popular one. So this index is including the 20 largest and most liquid equity instrument, and it's important to note that there is a cap. So every single stock included in this index cannot be higher than 20%. So there is here, you can definitely know that there is, you can see here, in Switzerland there are 3 big stocks, Nestle, Roche, Novartis. So those stocks, if they're included in the SMI, they cannot go over 20%. There's going to be a cap on this one. The last one, which is very interesting, is the SMIM. That's going to cover like the 30 stocks which are right after the SMI. So in the SMI you have the 20 largest stocks, and right after you get the 30 stocks which are going to be included in the SMIM, which is big and medium stocks. So now we're trying to compare the returns. So bear in mind, everything is in Swiss francs, so it might look very low as a return, but bear in mind that the Swiss franc has been appreciated against the other currencies. And secondly, bear in mind that inflation in Switzerland has been 0%, like over the last 15 years, 10 to 15 years. So if you're saying here, this one, the SPI, which is the Swiss index, it's been roughly 4.82% for 15 years. The SMI is going to be 4.94%, and the SMIM is going to be 5.40%. So it's roughly the same. So you have a smaller, higher return on the SMIM, but it's been more volatile as well. You can see it's been 17% volatility, while the other one's going to be only 13 and 13%. So on a risk-based adjusted basis, I'm not sure the SMIM is the best one, but if you can bear in mind high risk, then SMIM would be the best one. But anyway, I would recommend investing in the SMI. I think that's the best one to invest in. So how can you invest? Now you know the indexes. So I would recommend you invest with UBS. They have a different range of funds, but there you are. If you're looking to invest in the SPI, I would always recommend as a Swiss investor that you invest in distribution funds and not in accumulation, which means that the fund's going to receive dividends from the funds it invests in, and then it's going to distribute you all the dividends. Why I would suggest that? It is because you need to fill in your tax return at the end of the year, and you need to fill in all the dividends that's been received by the funds, either it's been distributed or not. So it's better to have a distribution, so it's going to be easier for you to fill in your tax return. So I would recommend one of those 3. So if you're investing in this SPI, invest in this fund, you get only 0.15% fees. Then for the SMI, you get only 0.20%, and the SMIM you get 0.25%. So if you're interested, you can click on those and you get further informations. So now let's say you are an US investor, individual living in the US. I would recommend you invest with iShares MSCI Switzerland ETF, EWL. So this fund is registered in the US and it's gonna pay a dividend. So it's gonna be easy for you to fill in your tax return. You're gonna get all the information. So if you're looking at the performance, so now it is in dollars, so be careful. Before we were looking at performance in Swiss francs, and now we're looking at performance in dollars. So over 10 years, the performance was 8.44%. So that's a really nice return. And it's following another benchmark, which is the MSCI Switzerland. So here it is. So the MSCI Switzerland is basically following the 40 biggest stocks in Switzerland. And you can see here they're comparing like MSCI Switzerland against MSCI World. And you can see that the Switzerland stock, they've been like overperforming like most of the time. And now the world has been catching up lately. So you get like a similar return. Either you invest in Swiss stocks or MSCI World. Over a long period of time, the return is basically the same. For investing in iShares, you will get an 8.44% return. Benchmark was 8.6%. I don't get it. Yeah. And the fees is 0.5%. And the last one, if you're living in the European Unions, I would recommend this ones from Amundi. It's accumulating, so it's not gonna pay you any dividends. All the dividends are gonna be reinvested. 0.25% fees each year. It's in Swiss franc, and it's following the MSCI, so it's gonna cover like the 40 leading stocks in the Swiss markets. Do we have anything interesting? It's registered in Luxembourg. You can only invest if you're a resident of any of those countries listed here. So if you're a Swiss investor, I would not recommend investing in this one. I would recommend the one from UBS before. And the performance, you can see, if you're comparing the index, they're doing very well. So the only difference here, they are the fees that are collected by the funds, which is roughly 0.25%. So that's why there is a slight difference between the fund's performance and the benchmark. And as expected, the three biggest stocks, Nestle, Roche and Novartis. There you are, so now you know everything. And I urge you to have a small allocation in Swiss stocks. They're performing very well. And it's very important to know that if you're looking at the three, most of the time the three first stocks that are including in the index, they're doing like roughly 60%, and they're mostly defensive. Nestle, it's consumer staple. Roche and Novartis, there are pharma stocks, and those three stocks, they're defensive stocks, so they perform very well, like in downturn or in recessions. They're expected to retain the profit, so the profit margin should not decrease too much. So it's good defensive stock to have during recession or stock downturn.